Hey everyone, thanks so much for joining the Think Realty podcast today. I'm your host, Eddie Wilson, the founder of Think Realty. In 2013, as a third generation real estate investor, I wanted to bring content and information to the marketplace that I had been receiving around the dinner table for literally my entire life. And super excited to bring our guest today to you. But before we do that, let me get to our sponsor. Our episode is brought to you by Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you maximize the return on your investments. Experience the real difference with Real Property Management. Visit Real Property MGT, realpropertymgt.com. Our guest today comes from Northern California. His name is Skye Ladari. Skye, thanks so much for joining us on the podcast today.
Yeah, I appreciate it. It's a pleasure to be here.
Very good. So you are with Crib Equity. And if you don't mind, just to give the viewers and listeners context, can you just kind of explain what Crib Equity is and what you guys do?
Yeah, absolutely. I'd love to. So I think one of the easiest ways to think about it is when we started Crib Equity, we really recognized that there were two challenges in the market for single family real estate. One is the sort of historic unaffordability of home ownership, which I'm sure is well understood by most in the audience. And the other is the challenge for investors in actually accessing single family homes as an asset class due to the high operational expense, both in time and money, for a lot of folks to scale a portfolio in that space. And so when we looked at those two things, we sort of recognized that there was this symbiotic relationship between the two. So when you look at the first principles and go unpack the data on, why are we in this affordability challenge? Well, there's a whole bunch of economic reasons and historic, trends that have developed over time. But really, the down payment is the biggest challenge facing homebuyers today, and that becomes the barrier for most of them to enter. Well, we have investors who have the capital on one side, but they don't actually want to acquire the home, to operate the home, to manage the home. And so we thought we could marry these two things together. So by solving the challenge for homeowners, we can also solve this challenge for investors about how do you put money to work in single family real estate without the cost structures typically associated with SFR. And so what Crib Equity does is we're a platform that allows for investors to essentially support homeownership by investing alongside a home buyer in their home purchase, providing equity into that home. And then they are effectively getting the exposure to that asset class. They are getting the leveraged equity, but they're using someone else's leverage who is owning and operating that home. And then they'll receive their return when that homeowner refinances out the home, when they sell the home, when they repurchase the equity directly from the investor. So in some ways it's a diversified method of accessing single family real estate without the operational costs and expense and the acquisition expense that goes into the SFR model.
Yeah, that's great. Brilliant model. And to me, what I love is that you're giving a source of investing opportunity, like the investment opportunity with a lower barrier to entry to the single family real estate investor, while starting to help solve the affordability issue. If you don't mind, talk just to our listener today about this affordability issue. We spend a lot of time in DC having conversations with legislators specifically about this topic. I really think with the election coming up, it's going to be a hot topic between both candidates, right? Like both sides are constantly talking through how do we solve this issue, because it is one of the major issues facing, especially Gen Z, Gen Y, right? Like this upcoming generation, the millennial generation, like struggling to get into home ownership. So you don't mind, just like talk to us a little bit about the issue that's at hand in the housing market.
Yeah. I mean, it actually, interestingly, it is the number one presidential election issue for Gen Z. I just saw a Redfin study on that, which I found fascinating. I think when we think about the challenge, in some ways, there's a lot of solutions, right? And government and regulators have a lot of tools at their disposal. Obviously, supply and unlocking supply and how we do that is a big lever that they can pull. And then there's a lot of other affordability tools. And I think the challenge that we see with many of them is that they artificially suppress the market, right? So you can do community land trusts, you can do other structures like that, where you're allowing someone to more affordably get into a home, but you're also capping their upside and their return, right? And I know that, all your listeners here understand the wealth creation opportunity of owning real estate. And so when we get someone into a home in an affordable fashion, we want them to benefit from that generational wealth creation of home ownership. And the same with the investor, right? So I think one of the easiest ways that to unpack the unaffordability that we found is really the market. When you look at it month over month or year over year, we talk about home prices are up 4% this year, 6% this year. But if you go back a few decades and you look at, when my parents bought their first home, the market is totally unrecognizable from where it is today.
Sure.
And the main driver of that is this wedge that's come between the graph of home prices and income growth. Right. Mm-hmm. And so 40 years ago, the average home was 2 times the median income. Right. Mm-hmm. And today it's 6. Mm-hmm. And so what's happened as a result of that is we've just sort of run out of runway on debt, is the way I think about it. Right. So, you used to be able to save a down payment in about a half year's salary, right, to get a down payment. Now it's a couple of years salary to get your down payment. And ultimately where that leads is now you're just financing so much more of your home, and recognize that a lot of creative mortgage products were brought to market that allowed for low down payment. And that was a solution over time. But as that gap has continued to grow between home prices and incomes, we've run out of runway, like I said. And so even if you can get 100% financing in your home, can you really afford that payment?
Sure.
And what we find is that most people can't, right? And in fact, the number one reason why folks are declined for mortgages today is their debt to income ratio. Mm-hmm. And that's not a problem that more debt is going to solve. And so I think when you look at just financial markets in general, when you reach that situation, equity is the logical solution to come in. And so, it's really about, what is an affordable payment for people? How can they get into the market? And then, as you well know, it's, once you're in the market, it's so much easier to continue to grow in that market rather than chasing it from the outside.
Yeah. I was part of a real estate symposium a few weeks back, and someone proposed this idea that the 30-year note structure, mortgage structure, was built when the average age of a human, especially in the United States, was 71 years old. Now the average age is moving up closer to 80, 81, 82. We're seeing a longer lifespan. And what was proposed was, should these mortgage structures change based on the lifespan of people, right? Their ability to repay this over time. Do you have thoughts on that? I think it's an interesting concept.
It is. I mean, I think I think the UK has a 40-year note, if I'm remembering correctly, and they were discussing introducing a 50, right? Mm-hmm. Which I think there are benefits and drawbacks to all these solutions, right? Just in terms of no one's ever going to get out from underneath
Sure.
A note like that. But I mean, I think in general the 30-year mortgage, the fixed rate mortgage, is one of the best financial products that's ever been invented for the consumer, for the investor, right? It's a heads I win, tails I win scenario, right? You lock in this rate on to buy an appreciating asset with leverage, which is it's not something that most folks have access to, unless you're a high net worth investor, right? And so that becomes why home ownership is the wealth creation opportunity it is, and then you have this rate, and rates go down. Well, now I get the lower rate. And rates go up, and I keep my lower rate, right? I mean, the 30-year mortgage is a beautiful investment instrument, and I think is one that you can only really take advantage of if you, again, have the assets to get into the home purchase in the first place. Right?
Let's talk about your model specific to investors. So I'm an investor. I have some capital. Maybe I want to, or I'm looking at the single family housing marketplace. Maybe the stock market's not performing like I want it to, or maybe my crypto, or whatever it is that people have been diversifying and putting capital into. How does the structure work? Do they get a preferred rate of return on this? Do they have to wait for a liquidity event or an exit? How does the actual structure of the model work?
Yeah, great question. So I think the first thing to just explain is, Crib Equity we are the technology platform. So we operate in the marketplace. There are some guidelines and rails around how the investment works that we oversee. There are also opportunities for investors to sort of tune the dials and pull the levers on how their investment structure works. And so, the first thing I'll say is, we do have a fund for that accredited investors can participate in. And then we also allow for investors to come on and invest directly through our platform as well, with a little bit higher threshold. So probably either institutional capital organizations, or even kind of like the RIA or pooled capital amongst
Sure.
an investment group is something we've seen also that would come on and deploy. And really when you do that, you are given the opportunity to essentially define where you want to invest, right? What are the geographies? What are the price points? What are the general profile of the assets that you want to own, right? So this is not a blind pool. You could tell us, hey, I really want to own, in these, 4 MSAs. And, I particularly think that, I want a minimum home price of, 500,000, or I want a maximum home price of 800,000. And this is the minimum down payment that the home buyer has to bring themselves, sort of thing, right? And so what we do is then we facilitate. We go out and find that folks. We have a network of realtors, mortgage partners. When we bring that partner together, Crib Equity facilitates that transaction. We have a shared ownership agreement between the two parties that basically, stipulates all the rights and covenants. And then the economics of it, which I think is really what you're getting towards, also is the investor does have an opportunity to take a preferred return if they choose, 6% being the upper bound there. And then we set a 10-year is the minimum term. Some investors we've seen do 15. We've seen others in the space do up to 30. I think in some ways recognizing that no one's actually going to be there for 30. So it
Right.
feels good to the consumer, but it's just sort of it's like getting a 50-year warranty on your roof. You might as well get like a 300-year warranty because
Right.
it
doesn't matter. Yeah.
Yeah, it doesn't matter. And so the homeowner is going to basically pay for all the upkeep and management of the home. And keep in mind, they're the only ones that have the rights to occupy, right? And use of the home. So they're going to pay the mortgage, the taxes, the insurance, and you as the investor are going to receive a pro rata return on your investment at exit. So, say it's $1 million home, you're going to put up 100,000 alongside an investor, or a homeowner's going to put up 100,000, but you each have 50% of the equity. And so when the home sells, the net proceeds get distributed 50-50 between those two. And that's really the structure that we've created that typically would, an average HPA environment. And again, this is the beauty of that 30-year mortgage and the leverage provided by the bank. An average, 4.5% HPA is typically going to be somewhere in the ballpark of a 16-17% net IRR on that kind of an expected 5 to 7 year hold time.
That makes sense. Great model. Appreciate you guys being a part of the Think Realty world here today and allowing our viewers and our listeners to understand. Most of our listeners and viewers fall into that category of more traditional retail investors, right? Like they've got 1, 2, 3, 4, 5 single family houses. Maybe they're dabbling in multifamily or storage units or something like that. And so I think this is a great model for diversification. I think it's something they definitely should check out. How do they find you? Where do they go to learn more?
Yeah, so cribequity.com. We also, for anyone interested in the investor side, they can email us at investors@cribequity.com. That'll go to our capital markets team and kind of get people in the right flow. I'd say also, for many people, we've seen actually a use case on the home purchase side, right? Because this is all sort of we've seen a lot of folks actually use our product or be seeking our product to purchase their own home because they want to retain liquidity to go use somewhere else too.
Sure.
So rather than being fully invested in one asset in one market, they choose to diversify that, right? And so I would say it's not out of the realm of what we've seen for someone to say, hey, I'm going to put down half of what I would on my house, but I'm going to take that other bit and I'm going to go buy a house in another market, right?
Sure.
And I'm going to get a cash flow on that, and it just works out better. So there is a lot of flexibility that's created for the home buyer in addition to the affordability piece.
I love that. It's almost an arbitrage model for the home buyer themselves to diversify their capital needed and invest elsewhere. That's great. Great model.
Yeah. It's a surprisingly common scenario, right? Folks don't want to go from holding a broad, diverse portfolio of assets and investments down to just their home.
Sure. It's great. Skye, thanks so much for being a part of the Think Realty podcast today. I encourage our listeners and viewers to go check them out, look at the technology they have, see if this makes sense for you. As always, we want to bring innovative solutions and ideas to you because in this ever-changing landscape of real estate investment strategies, you have to really invest based on where the market is, where it's going, and where you believe it will be. And so this is another great model. Also, if you are in a place where maybe you have 3 or 4 or 5 or maybe 50 houses that you're renting, maybe this is a solution that you can provide to your tenants. There's probably a lot of opportunities there for tenant solutions and you taking your tenants to the next level and doing something good for your community that you serve. So I really encourage you to go be a part of that. I want to say a quick thank you also to our podcast sponsor again today, which is Real Property Management. This episode is brought to you by Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure that you're maximizing the return on your investments. Experience the real difference with Real Property Management. You can go to realpropertymgt.com to learn more. And before I sign off, I want to say a quick thing about our Think Realty Plus membership. As we've been providing solutions to the real estate investment audience for years, we always wanted to keep it a low cost so we can be a companion for life. We've got the magazine that comes to your doorstep. It's also on the shelves of Barnes & Noble. We have conferences twice a year, a virtual conference once a year, and then constantly providing solutions and content and information and access to great ideas in the marketplace. If you actually will go and use the code LAUNCH, all capital letters there at the thinkrealty.com website, you can get our full service membership, which is called Think Realty Plus, for $14.99 a month, and you get everything we have to offer. We think it's a great deal for you, the real estate investor, to stay educated, stay up to date on all things real estate investment. Thanks so much for being a part of the Think Realty world. We appreciate you. As always, comment, let us know what you think, any ideas you have, and always let us know what you think of the podcast guest. We appreciate your participation. Have a wonderful day and happy investing.